All right. And we are live once again. It is Wednesday, and we are live with Exit Liquidity. I have with me, as usual, Captain Rational, the captain himself. And we are going to discuss macro and probably crypto and everything that's going on in the world. So let's do this, man.
My
How's it
man.
going today? How's it going?
Good start of the day. Charts look interesting. We have our
Indeed, they do.
eyes on stuff.
Yes, we do.
We talked about gold. We talked about the dollar. Look at that Japanese 10-year, US 10-year.
Oop, let's see. Hold on. I just got rid of you. There we go. So I guess we'll just get right to the charts. So gold. And this is indeed a very interesting chart. Like this right here is very interesting to me.
It's understated, particularly because of the paper market. For this chart to go up, there has to be remarkable demand. And that's the structure they created with the capacity to paper short, which affects spot price. And there's unlimited currency. So sovereigns do have a capacity to literally hold down the price. So for this to go up, they need to be significantly mal managing the fiat infrastructure.
Yeah. Yeah, no joke. Like, let's see. Let's zoom out a bit. Let's take the Captain Rational view of 3 months and just look at kind of what has happened in the past when we pushed up against these like new highs. So like that's very interesting. So like the local peak happened in January 1980, which was when interest rates were super duper high, which is fascinating actually because gold being an asset that yields nothing. Um, that is very interesting. And then what do we got here? October 2011. That is
And then the
interesting.
meltdown. Yeah. That's when they started QE, more or less.
Yeah. And then things went down as we, got into tech boom, whatever, and then just took off
Was
going.
look at the deviation. So I'm big into premium versus discount. So look where it found support. Let me go to my chart so I could get you some dates. It found support on that 3-month chart in what was that Q3 22. But look where it found support midair. It's not like the market buyers in 2022 when it broke to the downside with a fresh lower low. It's not like they waited for a discount relative to average pricing. They
Mm-mm.
bought still at a premium.
And look at
I
that. Look at that candle. Like that is huge.
Yeah, it's a statement.
Yeah, it definitely is. And like, I also think it's very interesting that you get these big runs in gold. Like that started about October '08. So everybody's freaking out. Fed's print money again, October 18, which that one's interesting because that one's sort of like front running all the stuff that happened in 19 and 2020. And then
I could
once again we're kind of pushing up against this
They
like
see what's coming. The gold market is there's the gold bugs, and they see what's coming. In 2018, they saw the system getting perverted, and lo and behold, in 2019 September, everything blew up. The entire banking system in the United States failed,
yep.
and it got more perverted. And what would be interesting is if it trends upward and we don't have an explosive move, and that's kind of where my mind is at. Actually, I'm kind of aligning with like that no hard landing. I think that's how perverted the system has got, and I think they're just willing to paper over anything at this point. Keep GDP high, inflation remains relatively elevated, and they're trying to just go full control over this fiat regime.
Yeah. Well, and this isn't something we've talked about too much, but like I think that's what the whole Basel Endgame thing is about again exerting more control um over non-bank type entities. And like the thing about non-banks is they've just become more and more and more relevant. And you're seeing this actually now in like private credit. Like I don't know if you've followed this at all, but like a lot of these like real banks are having like these private credit arms that are like doing non-bank type stuff. And it's that should tell you everything you need to know about how effective these regulations are at bottling up the demand for credit and the demand for balance sheet expansion, because like having all of this limitless supply of collateral in the form of treasuries that you can or not just treasuries either, like agency MBS is just as good almost, all sorts of things. Like you can use these things as collateral against other loans, and you can do that in a way that isn't as impeded by all of the balance sheet requirements. And so like, you know, who
It's-
needs all the Basel stuff when you can just, exist in the repo market and
some interesting observations. Up until '08, we had business cycles, and '08 was the culmination of where the business cycle would have taken down the system, the banks would have failed, the ATMs wouldn't have spit out cash. So the Basel Endgame, as you mentioned, they're at the point where they do have, or they really want to hit the final nails in the coffin for totalitarian control over the banking regime. But as you mentioned, the non-banks, they want it so bad because the non-banks, the Eurodollar market, payday lending, or was it buy now, pay later type stuff, which is just you don't even have credit expansion in the credit cards anymore. So now it's buy now, pay later type private credit. That will still allow the business cycle because that credit can expand, 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 and then default and it implodes. But from the banking system, they've controlled the banking with these types of regulations. And they want that type of control in the private credit because that's what they just spent the last 15 years trying to control in banking. Non-banks are still outside of it, and they're afraid of it because that'll still allow a massive expansion and the contraction and a business cycle. Their whole necessity is to suppress that full business cycle at this point.
yeah, and this has been a trend of just, thinking that we're somehow above a business cycle and that we've outsmarted, you know, human psychology. And it's just simply not true. It is not true in the slightest. And so, like, I think that, like, we need to get away from that whole mentality and just sort of let this stuff work itself out naturally. But obviously, that's not what we're going to do. Um, so I don't know. Like I just get so frustrated with this whole like regime of just okay, well, we obviously like the whole new Keynesian sort of idea is like, okay, well, when the private markets, credit contracts, the government makes up for it. And then you're supposed to do this kind of like thing where you keep it balanced, which works in theory, but the problem is that the one side never stops. It just goes up and up and up and up. And then they issue all this non-bank collateral in order to go up and up and up and up, and that just pushes everything up and up and up. And so that's where we end up. And so like that is why your dollar is devalued over time. It's because of this whole like new Keynesian sort of philosophy where you think you can outsmart the business cycle, and you can't. It doesn't work
Can't.
that way.
And that's what so maximalist, Bitcoin maximalism, they want to fix these fundamental characteristics of of an economy. And where I am at mentally is that money issuance is only a part of the complexity or the real issue that even they are arguing needs a solution. The other part that isn't talked about at all, like fix the money, fix the world type narrative, is you could fix the money, but that doesn't fix shit about the business cycle, because the business cycle
No.
is not about money. It's not about the printing money, the issuing money, base money, supply, so on and so forth. That's all about credit. So what is needed more than fix the money is fix credit. Fix credit, fix the world, because that's exactly what all the sovereigns are struggling with, and that's Basel III Endgame, and so on and so forth. Fix credit. If you fix money, you don't fix anything, because you're going to build credit systems on top of whatever freaking money there is.
Exactly. I mean, if I just pushed a button, boop, now you have a Bitcoin standard. That doesn't fix anything, because now you're just going to create a system where you have a collateral that is Bitcoin that you base a credit system around, and you're still going to be subject to almost all the same problems you were before.
Do you think that the milkshake? Could you imagine what the milkshake would be in a Bitcoin regime? The milkshake is suppressed because of M0 expansion. They print it's not even M2, it's obviously the Eurodollar market and private credit. So they expand the currency supply so much at the credit level. What happens is when they increase M0, that deleverages the system. But since Bitcoin cannot accommodate, you can't deleverage that credit system. So it would be worse. The milkshake would be infinitely worse with the Bitcoin standard, but that's a good thing and a bad thing. It's a good thing because it fixes money. It's a bad thing because there's no control over capacity to deleverage the Bitcoin liabilities that will emerge in such a system. I love talking about it recently, where there's way more than 21 million Bitcoin in circulation.
Oh yeah, there are. There's all sorts of paper Bitcoin in the form of futures contracts and all sorts of ways of creating derivatives on top of Bitcoin.
Of course.
Like, and that's not going to change. And that's the thing about hard money. That's why gold, again, coming back to gold, it has all those paper contracts, and none of the things that are wrong with gold are going to be really fixed by that from that sort of monetary perspective.
No.
Like, you're still going to have all of these sort of derivatives that are based upon it, even if the money is quote unquote fixed. And like you said, like about credit, like one thing that I like to think about is just like, look at this chart of the Federal Reserve balance sheet, right? Like, I don't think of this as being like, oh, look at all this money we printed. We printed money from here to here. Like, we just doubled the amount of dollars in the world, or whatever bullshit that you see Bitcoin maxi spouting. It doesn't really work like that. What this really is this is the visible spectrum of money to those on FinTwit. This is just the money that is inside the US system. And so what happens is, when you get these non-bank private credit sort of bubbles. They print tons of money.
Sure.
They print tons of money. And then what happens is you get a huge contraction in that market that threatens the domestic system. And when that happens, the Fed has to step in
Buy the
and they
shit.
have to buy all the shit. And they're just bringing it onto the visible spectrum.
Mhm.
This is not new money that had to be created. This is really just money that has changed forms from the less visible form of private credit, Eurodollar money creation, non-bank money creation, whatever you want to call it. And it's just moving onto into the regular banking system, But the problem is the tighter they make the regulations on the regular banking system, it doesn't change anything about what happens outside the banking system, because it's still, much to their chagrin, the world is not beholden to the financial regulations of US banks. And so they just can't do that without it expressing itself on the balance sheet eventually, because there will still be booms and busts. It is human psychology that there will be booms and busts. And this is evidence. This is evidence that the boom and the bust happened. This is, we're in the boom now, right? Like, things are going great. Like, you get the no landing scenario, but like there are cracks in private credit forming. Like, and
Interestingly, when the private credit, when it explodes, it hits the balance sheet. But this balance sheet coming down is healthy. It means that the private credit, the private dollar market has expanded to such a degree that it could even absorb any of what previously exploded and made its way to their balance sheet. So it's healthy for the.
that is a very, very, very good point. So I watched this video yesterday, and I was talking about this on Tap Talk yesterday. But Andy Constant, do you know him? Damp Spring. He's a macro guy on Twitter. Excellent follow. He made a video just talking about the RRP, and he was talking about the fact that like the RRP going down has basically been a function entirely of mechanics. And it's two main factors that have led to the RRP dropping. And it's exactly what you just said, just slightly differently. So this is the TGA. TGA rebuilding sucks money out of the RRP, and the Fed balance sheet dropping due to QT mechanically, because they have to balance their assets and their liabilities. By decreasing their assets, they also need to decrease their liabilities. And so it's a mechanical function. And just like you just said, though, this is not about necessarily liquidity moving or changing in the amount of liquidity. It's not the amount of liquidity that's really changing, is what I'm, understanding. And that is like, instead, what you're seeing is liquidity changing forms. You are seeing it move from the broader banking system into the non-bank world. And when it does that, it grows because it's unimpeded there. You're releasing it back into the wild, letting the animal spirits into the wild. And as long as this is happening, you're going to see those animal spirits. So Like we are in a boom, and that is
Pre-boom.
why we have not crashed yet, because things are booming. But all this talk of like a pivot, which is where this, title came from for this episode, the pivot is coming. Everybody's talking about this pivot that the Fed is going to do. And I just wanted to go into this because that is not bullish. And this is why, because a pivot means the end of QT. It means, probably
Wait.
in theory, like if they were to lower interest rates, I think you would see everybody run out of the RRP into treasuries, because so I think you would see this drop off if they were to do that.
I see this all as pre-boom, though. What do I mean by that? So when the Fed's account and they're QTing, they're pushing these assets back into the economy because private credit has a capacity to absorb it. And that is a forward-looking indicator on liquidity conditions. How long? 3, 6, 9, 10, 12 months. Because now these assets need to get into circulation, and there's only one thing these assets are going to be doing in the private banking world, or in private credit land. It's going to be used to significantly increase money supply. So these are forward-looking indicators. We have not had the boom yet. Still need that's exactly why middle of next year seems favorable. So destination versus path, and I think the path is still littered with landmines, but the destination is pretty clear. It's when they run down the darn Fed account and they're getting everything off the balance sheet, they're QTing all this stuff. It's like putting fuel into the fire, but the fire hasn't been lit yet.
Yep.
So the Fed balance sheet is sterilization. They are sterilizing these assets. They're removing them from private credit land, where in private credit land they're fuel for the fire.
Yeah,
Yes.
Exactly. And they are literally on fire when they do this, usually, because it means that something has gone awry in private credit land. And so like that's why you get this sort of like perverse system that you do, though, because the system is basically incentivized to take private credit risks sufficiently large that the central bank has no choice but to backstop you.
If to backstop anything at this point, it's so perverted and anything
Right.
will blow
Well,
it up.
and this is something I talk about too a lot, which is all of this. I mean, everybody talked, like, I remember coming out of 2008, everybody was talking about the interconnectedness of the banking system and how that was the real problem. But it's really just a feature of the system, and it is the problem, to be honest. But it is just a feature of, like, all of this too big to fail stuff is basically the end result, to me, of that ultimate decision to make $1 at Wells Fargo worth the same as $1 in private credit land, as $1 at Deutsche Bank, as $1 at JP Morgan, as $1 at the Federal Reserve. If the underlying assumption is that all of those dollars trade at par, this is what you get. This is what you get. And this is why I really, really despise this characterization from our governmental figures that stable coins are a problem.
They're actually a solution.
They're a solution. The solution is not everything needs to trade at par. It shouldn't trade at par, because if it does trade at par and it doesn't deserve to trade at par, that's what you get. You
It
get bailouts
exposes
after bailouts after bailouts, because you get this interconnectedness that eventually leads back to a school bus full of children that are going to starve to death. And then you go, well, obviously we have to bail them out. Otherwise, you will get a school bus full of children starving to death. And
I love that statement. Um, bank dollars, bank money, bank deposits are pegged to a dollar. They are a dollar. They're equivalent to a dollar. But that's like saying a stablecoin is a dollar, whereas stablecoins in a free market on AMMs have to arbitrage and you have to balance the LPs.
yeah.
So
And if at any time during a panic, during a bank run, you get a discount on those assets, and so you create it's a much more
it's a free
robust
market.
system. You're right. It's a much more robust system because
It
sure,
exposes the weakness.
I might think there may be a hole in that balance sheet. Yes, there may be a hole in that balance sheet, but how big is it? Is it 50 cents on the dollar big? Because I might be willing to step in at 50 cents on the dollar, like, and so what happens is the people that are most price insensitive are able to step in, and the people that are least price insensitive are going to have to bail and take the loss. And that loss gets spread out to those that, it gets spread out through the system in a way that like reinforces good behavior, such as doing your due diligence on whoever you're doing business with and whoever's stable coin you're holding. You need to know whether or not that person or entity is going to be a good steward of your deposit.
Whether they could back the liabilities that they've extended to the general public.
Exactly. And so like I see stablecoins as the solution to the problem, not the problem itself.
Interestingly enough, Circle is just an extension of a bank liability, but when it manifests as USDC on the blockchain, it becomes a different type of liability because it's free floating. So you can always redeem it for $1 because bank liabilities are redeemable for $1. So that's a little awkward, but when you got these endogenous stable coins that cannot be redeemed for $1, there are a much more organic and natural expression of the health of the balance sheet.
And remember, I don't know if you remember this, like there was a big Tether scare. It was right around the beginning of 2022, I think 2020. Yeah, I think it was right around the beginning of 2022. There was a big Tether scare, and Tether dropped to like 90 cents on the dollar or something like that, 92, 94, 95, I don't know, somewhere in there. And during that time, though, while that was going on, because I was watching this on the blockchain, I was checking the chain, as it were, and USDC spiked up to like $1.08, which is what you would want to see in an actual panic, right? You want to see it punishing people that are flighty and you also want to see that like rush to quality, right? Like you should be paying a premium for that quality. Obviously the arbitragers will get it back down, but like you see that flight to quality express itself in the price. And the problem is there is no, and if you don't have that expression, then you will have no incentive. And if you don't have an incentive, then you don't get the actions that support a market that is healthy. You don't get those incentives to do due diligence, to be thinking about risks. And instead you just get, well, I don't know, if anything goes wrong, it'll end up on the Fed balance sheet and it'll be fine.
And it also it's so wonderful, like Tether survives. those types of scenarios because we've seen stablecoins fail. And that implies that as much as actors had fears, FUD, fear, uncertainty, and doubt, and they sold at a loss to buy something at a premium, the balance sheet was capable of restabilizing their liabilities.
Yep. Yes.
It's a test. The market needs to test the infrastructure. And that doesn't happen with bank liabilities at all.
No. I mean, you need to have the market expressing what is happening, because you can paper over that. That's what China's doing.
Oh my God.
You can paper over giant holes in your system, and you can pretend that everything is okay. You can kick the can down the road. You can extend and pretend, but eventually the free market will come for you, because at the end of the day, all you're doing is perverting the incentives of the system and corrupting the natural sort of uh robust flow of, you might get booms and busts because of people, you get a business cycle, but the thing about that is that cycle at the top, it punishes people for getting overzealous, and at the bottom it rewards people for
Seeing
being
value.
visionaries and seeing value, and you need both of those things. You can't just have boom after boom after boom after boom. Like, it doesn't work that way. All you do is you create a perverse system that doesn't have that healthy rhythmic heartbeat.
Now, bear in mind, I do think there's solutions. I probably align as a Keynesian more than an Austrian. So
Well, the Austrians are out to lunch, I think, too, because they don't think about, honestly, I think if I'm going to align with any particular ideology in the economics world, I align with I'm not sure if you're familiar with Perry Marilling. He is, what is his little thing called? Oh, the money view. He calls it the money view. And I align with the money view, which is a lot. And I think you do too, to be honest, based on all the conversations we've had. Like, his is very much like looking at it from this perspective of like, what is the money doing? How is the money actually working in real life? Not just these sort of like ivory tower ideas that have taken none of this into account, but you can cram it into an econometric model and it'll spit out some numbers that, if you backfit them hard enough, will sort of look like they predict things.
No, you got to inspect this thing from a day to day. The data tells the story. And the story, these models have all been, as everyone's been talking about lately, the models of past have been completely invalidated. I think post 2008, the economy is different than probably post 18. 19, the economy completely transformed again, and then in 20, it was the quickest transformation, and it's the intervention, the standing facilities, standing repo, standing reverse repo, and most recently the BTFP. That changes the incentive systems for across the board.
Yeah, it does. I mean, and that every one of these little 4-letter acronym things like the BTFP or the standing repo facility, all these various like facilities that they stand up in order to paper over some hole, or fix some liquidity issue in the system. I mean, sometimes these things are generally profitable for the central bank, and I'm not even saying that like central banks don't have a place in the economy. But I think it should be much more minimized than it has become. Because like the central bank it didn't used to be like watching the Super Bowl every time a central banker was talking. It was like they were just another bureaucrat that didn't really have any impact on the wider world uh, until like, basically,
70s.
yeah, about the 70s, 80s is when they started like going down this road, but it's only gotten worse. Like the last 50 years have been just up only in central banker power because they've just every time something breaks, it's just a reason to, oh, this time we need to go a little further. We need a little more control than we had before. And obviously, if we had this control before, this never would have happened. So you should give it to us. And
So bear in mind, there hasn't been a crash. Let me explain that thought. .com. Any of these things, a real business cycle would have cascaded to lower and lower and lower and lower to banks to lower and lower and lower. They intervened in .com. They intervened in 87 and they weren't crashes. We haven't had crashes. They were merely corrections. And they stabilized it and buyers stepped in. I mean, literally that's just an observation by looking at the average prices. Looking at time-weighted average prices or moving averages, going back to 87, 2000, 2008, these were literally just mean regressions.
yeah. Yes.
Wild. We literally haven't had a business cycle since pre-70s.
Yeah, like a real one.
Like a real one with zero intervention. The Fed balance sheet they just had to start doing that shit post 08. They didn't really do any of that in 2000, but they stopped it because otherwise it would have gone lower and would have kept going. And then you would have had no GDP. It would have been negative GDP, and then more companies would fail, and it would just keep going and going and going.
Well, I mean, I don't think you need necessarily like a Great Depression style. I wouldn't call that a normal business cycle. What happened there?
That was all credit too. That was
Well,
Great Depression.
there was a lot of credit, but there was also just a lot of central bank activity during that one where they were actually working against themselves. Doing things like not like they were raising interest rates to try to prevent inflation before inflation was even a thing. They refused to lower interest rates when they needed to. Like there were things that like could have been done differently, I think, on a central bank level that could have made the Great Depression much less bad. And so I think I don't know. I don't even know. Like, is a theoretical business cycle even relevant when you have people with this much weight that they're pushing on the scales?
No, it's not relevant nor possible. The only way you have a business cycle is without a central bank, and which means the individual banks, their balance sheets matter, and the amount of bank money they've issued, they fail if they cannot meet their liabilities, and that's a business cycle. And that means the Great Depression wasn't really the full extent of a business cycle. You need to go probably into the 1800s to inspect that. Silent Depression wasn't even a business cycle.
Yeah. I mean, the 1800s was when you had some of these like quote unquote wildcat banks that everybody sort of like looks at as being a bad thing, right?
It's money.
But it was private credit and it was pure private credit. And I think that's maybe the difference, right? Is that because we keep switching which regime is actually important, whether it's private credit or whether it's the Federal Reserve, private credit, Federal Reserve. And so like that transition is why you get, okay, hey, look at this. Let me pull up the chart again. They're pulling off the gas on the Federal Reserve, but private credit is picking up the slack. And so like
There
we
you
keep
go.
doing this dance where
Yes.
where which one is more important at any given point in time. Right now, it's private credit is what's important.
Well, right now, credit is getting primed. They're literally so look, they've contracted the Fed balance sheet to wherever they have, and um, next year, Treasury issuance between the Fed balance sheet contraction and the Treasury issuance required for next year, there is about to be the largest tsunami of collateral flooding the system in history. It will make 2020 look like it just gets bigger. It's just the private credit in 24 could be monumental.
Yep. Yep. Yeah. I mean, that's assuming we don't get some big blow up in private credit, which could very well happen. And to that point, I would like to say that like the next time that happens, I think you're going to see a very different reaction function.
Mm.
Because of what we just went through with inflation. I think, I mean, I don't know. It's hard to be sure what the reaction function is going to be without knowing exactly what precipitates it, what the political climate is. But from where we are right now, like if all of a sudden today you just were to get some big blow up that has yet to result in like massive job losses or change in the economic status of most of the people, I think you are not going to be able to see the same level of we need to step in hard and fast and now from the Fed that you saw during 2020. I just don't think they will be as willing this time because they're always the generals fighting the last war. I just don't think they will be willing to go at it as hard as they did last time. And I don't know that the Treasury is going to be able to spend like they spent before in order to support, because like the amount of spending that came out of COVID was just astronomical. Like, and I
10
don't,
trill.
yeah, and like astronomical amount of treasuries that hit the market and became collateral in the private credit world all at the same time that the Fed is expanding their balance sheet.
They literally all got bought, which is fascinating
Yeah,
because rates went to zero.
right. I mean, and yeah, well, and they sort of tricked everybody into buying them too. And that this is part of the problem of the perversion, right? Is that the Fed, by expanding their balance sheet and having all of these requirements about bank reserves, because like the banks were literally constrained because they had too many bank reserves on their balance sheet, so they had to get them off. And so, what did they do with that money? Well, some of them bought a bunch of 10-year treasuries
The worst
and
possible
that
price.
at
Pico top.
prices that were basically pico top and artificially placed at pico top. And then the Fed gets mad at them when they fail because they're holding all this garbage tier U.S. Treasury that they bought at the pico top.
You can't make it up. You can't. It's real. So but he couldn't make it up if it wasn't real. Like this is the shit that they pulled, or what had to occur for the system to remain sound. My general opinion is if just as I say in September 2019, the U.S. banking system failed. If they didn't do what they did in March of 23, it would have been bank failure, bank run. It would have been a cascading effect. So March of 2023, the United States banking system failed. It would have been conditions for a full business cycle where everything would have been ground down to zero, stock market collapse, the entire corporate landscape and small business landscape would have been, brush fire, completely decimated. They bailed it out. My opinion also is generally that these are the conditions for Japan and China. So whatever they're doing from a government geopolitical perspective, they're bailing out Japan and China because there is no organic solution at these extremes. So they're in the process of trying to create those cyclical conditions for yen to be bid, China to figure out what the hell they're going to do with
So
real estate.
let's talk about Japan real quick. Because this is very interesting stuff. And we meant to get to it last week and just didn't get there, but that's okay. Gives us more to talk about this week. So here's the 1 week chart of the Japanese yen, right? And so you can see that like you had this upward trend, and just a couple weeks ago, it just fell off a table. And that's very interesting. I mean, it also is very similar to what happened at the end of October last year, where I honestly believe that there were some shenanigans taking place here, because the Bank of Japan was getting very, very worried
Yep.
right here. And even I remember there was a tweet from Biden talking about, we're looking at the strength of the dollar, and it was like right here.
So interestingly, look at the correlation or the inverse correlation. Historically, the yen rallying is a sign of something systemic breaking, but crypto bottomed in Q4 of 22, and so did the yen.
That is interesting.
It's kind of like the story we've told about treasuries long end correlation to risk, broadly the equities markets, the reversal of correlation. That'd be really weird to see the yen rallying and crypto rallying and the bond market rallying and the dollar falling. These would be a significant change from traditional market structure.
That is interesting. I guess it is a USD pair though. So like yen rallying would be US dollar falling, which that correlation is sort of well understood by people, that like when you get the dollar devaluing, such as you got at the end of 2020 into 2021, that was a huge crypto rally. And then this dollar just obliterating the world was when things were bad. And then when it peaked, it was risk on.
So how does the dollar go down? And that's where my mind is at with Japan and China. The dollar cannot go down for organic reasons, considering the debt construct of the planet. The only way it goes down is if oil rolls over and some sort of strategic geopolitical intervention.
I mean, yes, I do think that strategic geopolitical intervention is the answer of what happened. But like we said, and I really, really, really like, and I might actually have to like write an article about this whole like private versus the public balance sheet thing, because I think this is a really, really important idea. But like, I think this combination of just juicing the hell out of both balance sheets, the domestic balance sheet and the private credit balance sheet, created this drop here, right?
Where did the dollar supply come from? Or where did the demand for the yen come from? It didn't come from the interest rate arbitrage. The arbitrage is the other way with the carry trade. So why would people want to sell dollars for those currencies? I can't. This doesn't makes no sense.
Well, I mean, that carry trade works both ways. And so for those that don't really understand the yen carry trade, we can kind of like go over that. But the concept is basically that if interest rates are high in the US, then, and so like you can buy things like treasuries that yield, we'll call it high percent or we'll just say 5%. Say you can yield 5% in the US. And then meanwhile, in Japan, for the sake of argument, we'll just call it 1%, even though it's like half a percent, 0.67%. But like we'll just say it was 1%. It did eventually tick almost up to 1%. So for the sake of easy math, we'll say 1%, right? So if I can borrow in Japan at 1% interest, and I can swap that yen that I borrowed for dollars, and then I can take those dollars and buy treasuries with it, I have now captured 4% in yield. But the problem with that, and that is called the carry trade, a carry trade, but the problem with any carry trade is that you're taking a risk there. And in this case, it's several risks really. You're taking currency risk for one, which you can hedge out. And so you have hedging costs associated with that. And the way you hedge that currency risk is while you're borrowing yen and buying dollars, you also need to be borrowing dollars and buying yen to hedge that out. So you kind of do two borrows to kind of hedge the currency part of the risk, but you're still taking asset risk as well. So basically, as you see treasuries or JGBs, which are like the Japanese equivalent of treasuries, as you see their interest rates come up, then it sort of makes people want to sell their US dollars to buy those treasury or those Japanese treasuries. And so you get that carry trade sort of unwinding. And when they're selling the US treasuries to do that, that's making the yields on treasuries go up and the yields on Japanese treasuries go down. And so like there's just this interplay here where depending on how much depending on what is going on in the two economies, like it may reinforce the behavior of wanting to move money one direction or the other. So I don't know. That's anything to add on that?
You could always throw in interest rated FX derivative contracts, leverage. So you hedge your yen to dollar to treasury, 4% carry trade with 10% leveraged. So you're only taking a small amount of capital. So you take in 1% of that 4% spread to cover insurance. So you're capturing 3%, but you're delta neutral.
Yeah, I wish there was a way on TradingView. Maybe there is if you pay extra for particular feeds, but I wish that I could get cross-currency basis swap charts, because that is how you measure the hedging cost of different directions on that. And that tells you kind of what the market is doing as far as which direction they want to go, whether they want to hedge their yen or whether they want to hedge their dollars. Like that cross currency basis swap can tell you a lot of information about what is going on with global monetary flows.
It's an interesting one, particularly because there's two ways to get a foreign currency. You either buy it, in which case you see your FX pairs adjust, or you rent it.
Yeah.
Renting dollars. So, let's say it costs 1% to rent dollars using yen, but you're going to get a 4% carry trade. You got 3%, and you grab a 1% derivative as insurance, and you got 2%. So you didn't even buy the dollars. So now you're getting your carry trade. You're not influencing FX.
Right. And that's just free money. That's just unless you get the asset depreciating, which, if everybody's selling them, can happen.
Well, that's the blow up. So that's what everyone's afraid of. Everyone's afraid of what happens if those derivative contracts fall into the money, and there's a quadrillion notional plus outstanding.
Right.
They're not settling, or they can't settle that. So the only reason those derivatives contracts are getting up to that notional is because they're literally banking on it never needing to be settled.
That is true. And another part of this interconnectedness is the fact that I mean, everybody likes to throw around the sexy, quadrillion, notional values of all the derivatives contracts that are outstanding. But the problem is, like, what is the net? Like, because if I have,
It's not
if
much.
yeah, exactly, it's usually not much, but like it's much, 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 much less than $250,000,000. But like, it's
Probably
basically
like
like if I was like, hey, Captain, I bet you $100,000 that the dollar goes up tomorrow. And then I also on the other side of it say, Captain, I bet you $100,000 the dollar goes down tomorrow. We have a notional value of $200,000 on the line. But in actuality, the net is zero. And so, like, because we're hedged. Now, the problem comes is if I go, Captain, I'll bet you $100,000 that the dollar goes up tomorrow. And then I go over to Jedi Blockmates and I say, hey, Jedi, I will bet you $100,000 the dollar goes down tomorrow. And the problem is now I have introduced counterparty risk. Now, if he doesn't pay, I'm not hedged anymore. And it might be a lose-lose. And so this is again where that interconnectedness comes in. You have all these various counterparties that have trillions and trillions of dollars of notional exposure to one another. This is why we have bailouts, because you cannot clear all of that risk.
it explodes and someone is left holding the bag.
Yep. So yep. So I saw some random comments on the chat. I just thought I would highlight here. So I am not who you know of as the Blockmates Twitter. That would be Grant. The @Blockmates Twitter is Grant. He has his own other Twitter as well. But Grant's a good dude though. And then
And I'm the captain.
yeah.
I run my own stream.
Yeah.
You don't know. Everyone
And
knows who the
I
captain
think you've
is.
definitely pulled in some people here on the channel. So
Brian, I know Brian. I know
yep.
Hilda. Lucian, I know these guys.
Yep. So we do these shows quite regularly. So if you're new to this show, definitely stop by some other time. We should. I'll probably get this added to the Exit Liquidity and channel, and I will also be getting a Exit Liquidity Twitter made and stuff like that, so that we can get this thing done up right.
You can
But
improve quality a bit.
yeah, working on all that.
So bear in mind, everyone, we just talked macro for all this time. We just talked crypto because crypto is a manifestation of macro. And everything that you're looking at with regard to Bitcoin price or Ethereum price, this is literally just a knock-on effect of everything we talked about.
Yes.
And when I talk about like liquidity conditions primed to be like historic or epic next year, that's going to affect the price action of liquidity sensitive assets. So that's literally Ethereum and Bitcoin. Number go up if liquidity go up. So very curious to see what happens.
Yep. And it's about these two, right? It's about the private credit, it's about the domestic credit and what they're doing. If they're both going like this, it's game on. If one's going up faster than the other, it's game on.
Yeah, I mean,
if they're both going down, that's bad times.
Like, is there a scenario where like the Fed balance sheet, ramps significantly, but global liquidity contracts more? That'd be weird because
I think there absolutely is that scenario. And like, this is what I was talking about with the reaction function. Like, if you get a giant blow up that kind of reverberates through the global system, and the Fed is only willing to backstop enough that they prevent catastrophic damage, then you could see such a thing, because it's really about inflation, deflation. Are the inflationary pressures sufficient to offset the deflationary uh credit blow up or whatever, so it's really just which one. In the past, in 2020, obviously they went way overboard on both.
Oh,
And
you could
that's why
say
you
that.
got the inflation that you did.
Oh, bear in mind that they also pushed a lot of money into the hands of the general public. My base case going forward is that they're going to do everything they can to constrain liquidity in the general public. They will, I won't say never, but not anytime soon will ever give money to the general public. That's just political suicide if inflation, consumer price inflation ramps up again. So isn't that just further of an argument of confluence suggesting the next couple of years are could lead to significant asset price inflation, particularly uh, Nasdaq and crypto? They need to create conditions that manage growth from a GDP perspective, which is becoming more and more financial. So they need to compensate, and they've done that well. The fiscal has created a huge amount of GDP this year. So they have all the incentive in the world to increase currency inflation, which can be talked about in terms of debasement, and juice the financial economy, which is a major component of U.S. government tax receipts, and uh, and then that's just consistent with the disparity narrative, where the real economy is stagnant, but the financial economy is booming, GDP is booming, currency supply goes up, not just from base money or M2, but also from private credit. And that's just everything points the destination of all these types of arguments point to significant uh, you know, liquidity improvement, which will have an effect on crypto as we think.
Yeah, I mean, I guess I there's a slight counterpoint here that I think, where there's a scenario where you could see something different happen. And so one of the things that that video I alluded to earlier um, was talking about is just this mechanical nature that, like, QT plus the TGA has caused this, basically, as we described, an injection into the private credit market. Um, right. But the problem is the TGA is basically as full as it's probably going to get. And so at this point, you're not going to see that tailwind that you had before. So the TGA has kind of gotten up to its normal level, and now it's just going to probably hang out around here. So you're not going to get that injection anymore. And then the other thing is your QT, is going to continue to take down the Fed balance sheet mechanically, which that will continue to inject capital into the.
QT, it's the opposite of what everyone talks about. This is literally injecting collateral into the system.
It is. I mean, it 100% is. It is indirectly injecting money into the private credit arena. But the thing I worry about is, and actually there was a Bloomberg article just the other yesterday or something, talking about how, like, some big bank CEO or whatever was saying that they think there's a bubble in private credit right now.
You think?
And so what happens though in a bubble when the flows slow down?
Well, they implode. You need I
Yeah,
mean, these are good points.
once the flows begin to slow, if there is indeed a credit in or a bubble in private credit, like when those flows start to slow down, it starts to look like the Ohm chart.
Really quickly.
Hold on, I gotta let's see. Let me see if I can find.
That'll do it. Maybe not.
Well, I think the problem is I'm just on a weekly. Where on earth are we?
You got to read.
There we go. It's like boom, 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 boom. Up. Then the flows begin to stop, and then,
Yep.
and that. I mean, granted, I'm not saying that our system is the Ponzi-ness of this, but this is very indicative of a bubble, and so I think it's it's interesting to think about the fact that if there is a bubble there, you're going to see it express itself, and some of the places it might express itself.
Are Bitcoin.
Well, I was going to say,
in that regard, it's probably safe to say there isn't a bubble.
So
we have yet to bubble in private credit.
I mean, that's possible. Maybe it's just the beginning of a bubble. And you know what, George Soros, I think it was George Soros that said that when I see a bubble forming, I rush to get in. So maybe that's the case. Maybe you're going to see HYG just pop
Go
up
right to the top.
Right to the top of this structure here. But like it's an idea, I guess, and it's something to keep an eye on. In the short term, I think we're fine. I think everything's good.
I think whatever
personally am risk on.
I don't believe in risk off anymore. I believe in cash, but I've redefined what cash is, as folks know.
Honestly, what's interesting is like there's this feeling that happens at the top of a bubble where being in cash feels like the riskiest thing there is. Like,
yeah,
when, you know what I mean? Where it's like, you just are like, if I don't put this money in today, I am going to lose so many gains. Like,
it's weird.
Not having any cash at all is just irresponsible. That the whole like cash is trash mentality, that is when it's time to GTFO.
Well said. Well said.
Like,
but we're nowhere near that.
But that's the thing, is you always need to be moving toward the risk. You need to be moving toward the risk, and sometimes that risk is cash.
And I define cash and I define Bitcoin as a cash nowadays. It just belongs right up there next to a euro or a pound or a yen. It's just an FX pair.
Yeah.
So treat it like FX, guys, and you could spend it. We clearly know you could spend Bitcoin by debit cards nowadays.
Yep.
So just treat it as a cash.
Yep. Very good.
All right, Ben. It was a good one.
It was a great one. And I guess real quick, because I made this chart specifically for this, and then we never actually even talked about it. Hold on, before we go. Talking about the pivot, because we were talking, that is the whole title of the stream here. I wanted to point out to people that like everyone is talking about this quote unquote pivot like it's a good thing. And this is a chart where the bottom here is the Fed funds rate, and the top is the S&P 500. And I would just like to point out that like the Fed funds rate dropping does not tend to portend good things happening in the stock market or with risk assets in general. That means that there are cracks forming and they're trying to get ahead of them.
Mm-hmm.
And if the bureaucrats are seeing cracks, it's already a full-blown fissure in the earth. Like, so I would not be feeling bullish about any sort of Fed pivot. We'll just say that. So if the Fed pivot is coming, time to be wary. But
Interestingly enough, it's not necessarily the case. Everyone expects that. And it's not because I'm a contrarian that says think the opposite. There's plenty of reason to think that from a Keynesian perspective, they have a decent control over the liquidity composition of the system right about now. And that would be the first time ever, because historically they're responding reactively, but they sure as hell were proactive with the BTFP in a weekend. So for them to have
not
the concept
proactive enough to do it a few days earlier and save SVB and
right,
all of the crypto banks, though.
yeah, well, that's the picking winners. But I think that's how perverted the system has gotten, to the point where they finally, maybe for the first time ever, have control over the system, and it would be a no landing. And they cut rates a quarter, a half, and things just keep humming along. And over time, the S&P 493, not the Magnificent Seven, just literally dissolve in an acid bath and become nothing. And new companies emerge, and whole recomposition of the entire system is changing.
Yeah. Yeah.
That's what I think.
Yeah. Well, and there's something to be said for the fact that they just issued a ton of treasuries, and they're going to issue a ton more. And then probably once they're done with that, they'll jack rates down to the earth, and then raise the collateral prices sky high, which will juice private credit markets even more. That is entirely possible. And like everything with macro, you have to recognize what the signposts are along the way, and you just keep your eyes on the markets and try not to be exit liquidity.
Well said, Ben. Well said.
All right. Very good.
Thank you, everyone, for joining. As always, a good one. Exit
All right.
liquidity.